Can anyone out-hawk the Fed? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Michael Kao, the CEO of Akanthos Capital Management and author of the Substack, urbancowboy.substack.com. I think I got that right. I called it Cowboy Musings. I don't know if you call it that, Michael, but
yeah, pretty much.
We're excited. We're excited about it. And it's great to have you back on with us. It's
Been a
been
while, yeah.
it's been
Thanks,
too
Deb.
long. But there's been so much going on. So I feel like this is, and almost everyone is saying, God, it's really complicated right now. So I think it's such a great time to have you on. Let's start a little near term. We had the Fed minutes come out just a short time ago. They predate all of the data, so it's a little bit backward looking. But the Fed has been sort of top of mind because we've seen this big swing in sentiment. The bond market now almost fully pricing in a June rate hike, although we did see Treasury yields move a little bit lower today. What is your thinking around the Fed? Does that seem appropriate given what we're hearing from Fed officials and the data we've seen?
I mean, this has been my base case since early last year, to be honest, right? I've been saying for a while now that I expect a structural inflation that's going to be hard to get rid of. And I've been tweeting all last year that I just don't think that an imminent Fed pivot is in the cards. And they've said that, right? But but the market, especially the bond market, has chosen to not believe the Fed. But everything seems to point in that direction. And with the recent spate of upward CPI revisions and even the recent print, and especially given how strong the economy has proven. I mean, this doesn't come as a surprise to me at all, which is why I think that we're about to see a resurgence in the dollar wrecking ball again.
Ooh, that's always a scary prospect. Let's back up 1 second. So there was a feeling that the Fed, and I think it probably came from Powell's press conference when he didn't seem as sort of angry and kind of talked about inflation moving in the right direction. I think people kind of ran with that mistakenly. If we listen to what you just said, how does the Fed fit in with what's happening globally with the global central banks? We started the show with a question that you posed in one of your pieces. Can anyone out-hawk the Fed? I mean, is the Fed the lead car here in this fight against inflation?
I really think so. So that thread that you're alluding to, I think I wrote that back in beginning of January, and I basically pointed out that there are a number of reasons, and I see you have one of the charts from that thread up there about household debt to income ratios. But in that thread, I highlighted, for instance, the U.S.'s relatively low household debt to income ratios. The U.S. is the lowest in terms of percentage of variable rate mortgages. From a central bank, asset weight perspective, also the U.S. has the most maneuverability, and you couple that with just the relative strength of the U.S. I mean, when you look at for instance, the Eurozone, or you look at the UK, even though the rates of inflation there are still significantly higher than they are here, I think it's a mistake to just think that Andrew Bailey or Christine Lagarde could really keep up with Powell, because I think the last UK GDP print was already skirting the zero bound. And not to mention, we all know about the gilt fragilities. Right. And then the ECB has its own issues with trying to, juggle a whole bunch of different spreads that they need to keep together with the TPI. And then you come to the big elephant in the room, which is China. Oh, I forget, before we get to China, Japan obviously is constrained by its yield curve control policy. And, the market went into a complete tizzy just because they relaxed that bound by 25 basis points. I still think that, the incoming BOJ governor will have to choose. If he has to choose between sacrificing the JGB market or sacrificing the yen, it's got to be the yen, I think. And then you come to the big elephant in the room, which is China, who we're embroiled in this great power competition with, right? China, I think, is especially vulnerable because they're still reeling from the effects of Evergrande, not to mention this multiple years of quixotic zero COVID. So today I was kind of trolling a little bit on Twitter, saying, I just want to know two things. I mean, did I miss the great China reopening? I wrote a thread about that as well, saying, kind of poo-pooing this whole idea that the great China reopening was going to cause, some people were calling for oil to spike to 200, and as much as I'd like that to happen, since I am a long-term bull and I'm invested long-term in that thesis, I really think that 2023 is going to be challenging for oil, at least in the first 2 or 3 quarters of this year, because of the demand destruction situation and the fact that China, this great reopening was so anticipated, but yet they're coming into it from a big position of weakness, right? Their product inventories are already at tank tops. So what are they gonna? It's kind of like, what are you gonna do for an encore? It's already kind of priced in. So I see the PBOC doing all it can to try to resuscitate the Chinese economy, and to me, that just puts more downward pressure on the yuan and up pressure on the dollar.
Wow, this is why we love having you on, Michael. There's like 20 things we need to unpack from that one answer, and they're all so important. Let's talk about the dollar wrecking ball first, though. So, we had a lot of people saying, that the top is in on the dollar. That it maybe extended even beyond where it would have been. That's it. The high is in. We have seen in the last 3 weeks or so the dollar strengthening again. Do you see a prolonged period of dollar strength because of the central bank policy and the fact that that there isn't anyone to outhawk the Fed, as you put it? Or is this a shorter term feeling that we're going to see that dollar strengthening again?
I think it's both short term and long term, and the reason why I think longer term also is because I think there is now a geopolitical reason to keep the dollar strong. So, in fact, I just came back 2 weeks ago from an interesting symposium at West Point where I co-authored a paper entitled "U.S. Dollar Primacy in an Era of Economic Warfare," and the idea. We covered a lot of ground in that paper. We talked about the importance of defending our flank from an industrial policy perspective, but we also talk about the importance of, when people talk about how the U.S. has weaponized the dollar, they're mainly referring to the seizure of, basically Russian reserve assets, right, and financial sanctions. And so in our paper, we actually talk about how that should be a shot across the bow of our policymakers, because when you over rely on sanctions, it definitely does encourage our adversaries to look for alternatives. However, given the U.S. dollar's hegemonic role in world trade, 60% of global reserves, 90% of all FX transactions, that game, I believe, is still the U.S.'s to lose. And so one of the things that we talk about at the end of the paper is how we're at a very interesting crossroads from a macroeconomic standpoint, where the U.S., for all of the reasons that we just opened with and talked about, right? The U.S. is in a comparatively stronger and more resilient position than its primary adversary, China, right? In terms of being able to weather a strong dollar policy and higher rates. We are still hiking in the name of combating domestic inflation, right?
Mm.
But a strong dollar, and I observe that a strong dollar has the potential to kill multiple birds with one stone, meaning that one, it is legitimately fighting domestic inflation, but number two, right, it delivers asymmetric burden on our primary geopolitical adversary, because the big tell to me, so you would think, right, that China, being an export driven economy, would want a weaker yuan. You would think that they would welcome, right? But to me, the big tell that they have other issues that they're worried about, meaning capital flight, is that when the dollar really spiked in, I believe it was Q4 of last year, right? Q3 and Q4 of last year. What did the PBOC do? They intervene to actually strengthen the yuan, right? When you would expect them to welcome a weaker yuan. So to me, that was a big tell, right? That they're very, very worried about capital flight. There was a great this guy Andrew Hunt in the UK. He did this. I alluded to this in a Twitter space yesterday. He did a recent YouTube interview where he talked about how he's done some proprietary research on 36 of China's largest banks, and that he believes, right, that there is basically a $4 trillion liability gap that is not captured in the public balance of payments data. When you look at the Chinese banking sector, the biggest problem, and I have one of these charts borrowed from 𝗗𝗔𝗬𝗦's latest book, in that Who's Going to Out-Hawk the Fed thread, that shows China's total private credit literally off the charts compared to every other large economy. And this is basically the same theme, right? You've got an over-levered economy that has basically borrowed short-term in dollar-denominated debt. And so when you've got this is a country that's importing 80 to 90% of its oil that's also denominated in US dollars. So even though right now the world is being granted somewhat of a reprieve in oil prices, I still think that in the next several years, because of and this is a whole topic of a different thread, that oil prices have the potential to spike. And if you have oil prices spiking at the same time the dollar is strong, China's going to be in a very, very vulnerable position economically.
Do you think this is what is driving them to? Because there's a lot of concern right now about the position vis-a-vis Russia. The thought was that they not really keen on what's going on, and you saw some distance between them. But now there's the visits; they're back out in the opening of COVID. It may be optics, but do you think that need to keep their oil price low, even if the world prices are high, is part of what's driving their strategy with Russia?
Oh, absolutely. I mean, look, both China and India have been beneficiaries of these price caps from the West, right? But I think what's really interesting, the interesting dynamic to think about here, is that those incentives, China and India's incentives run counter to Russia's incentives, right? Because Russia obviously wants to maximize commodity prices. China and India are totally happy to see these price caps, and receive these discounts. Now, the problem with China and India, though, is that the extent to which they can capitalize on these discounts is somewhat limited now, because they're already kind of filled up, right? So there are so many there's so many ripples and counter ripples in this macroeconomic pond that it's very, very hard to analyze what's going to happen.
It is. And, it's interesting. I love that image too. I know you were talking about that, we had this very placid environment for so long because of liquidity. And now you've had these major shock events that are kind of creating all this turbulence. And it is hard to figure out, I don't want to say what's real, but figure out what you should be investing in and what might be more temporary and noise. I'm laughing as the phone's ringing. I don't know if it's us or you, but it's like, is the general calling? I think maybe the general's calling. I love that you were at a West Point symposium. It's such great intel on the strong dollar. And by the way, if you have a question for Michael, you know what to do. Put it in the chat and we'll try to get, I know this is going to fly by this 30 minutes, but we'll try to get to them if we can, or you can tweet us at realvision. If a strong, there are geopolitical reasons to keep a strong dollar. What happens to corporates? I mean, a strong dollar is not great for earnings and for presumably stock prices.
No, I think it's not a sanguine outlook for risk assets, especially given how far they've come. Right. I think that I tweeted earlier, literally just a couple of minutes ago, saying that, to me, this setup right now, it feels very much like we're in Q1 of 22. And if you go back and look at your various charts of where equities were, where gold was, where Bitcoin was, go look at where we were in Q1 of 22. Ugh. But that, to me, that's where it feels. That's how it feels. I mean, after late last year's big risk off, I thought, okay, well, maybe we finally moved to the third inning of this, what I think is going to be a long drawn out, difficult period. But honestly, the risk on of the last several months, I think, have rolled us back to like the second inning. It's that's very worrisome. But the good news, hey, look, to me, the good news is that Tina, remember her? She's kind of died a grisly death, and her friend Tia, there is an alternative, has taken center stage. So I'm very happy to clip 4 3/4 risk free, and just like bide my time. I mean, I'm pretty defensively positioned right now, but I've been building a lot of liquidity because I'm not sanguine on risk assets.
So is it just that we grind and it's this choppy environment for risk assets, or do you think there could be another serious leg down if you're talking about comparisons to Q1 22? How ugly could this get?
So that's been the lack of volatility has been one of the biggest confounding things of this grind, right? And there's so many theories that I've heard from the prevalence of the zero data expiration options to perhaps the countervailing forces of energy outperformance vis-a-vis other sectors and whatnot. I don't really have a great answer for that. I was incorrectly positioned. One of my worst trades in Q4, I'll be honest with you, was being long VIX, right? And that was a terrible trade. So I blew out of it. I'm like, you know what? Maybe that indicator is broken, like some people say. So I'm not playing that. I don't know.
Yeah, it's strange. A lot of people have been pointing to this, and it's strange and it worries them because there may be an explanation we don't know, or things are just coiling, which means that when it breaks, it's going to be even more severe. You mentioned Japan, the BOJ. This is another one of these things. I think I saw Brent Donnelly tweeting today, weird there's not more activity in the options market around this event, which everyone kind of knows they're going to be forced to make this decision. Does that worry you that when you see that changeover and they're going to have to, I think you said, choose between the yield curve and the yen? Do you worry about the implications of that? Because it seems like one way or the other, we're going to see an extreme move.
I do. I'm not playing in the yen myself, mainly because I see the potential of some sort of violent move one way or the other. But yet, if I had to make a move there, I would rather be short than long the yen.
Mm.
Um, yeah, I don't. It's I a couple of months ago, you may remember I wrote a thread. I called it, this is kind of like an every man for himself kind of geopolitical mosh pit. And I retweeted it today because I feel like that it's still very, very much relevant, because the geopolitical objectives are certainly divergent amongst the economic zones, but so too are the macroeconomic objectives. So it literally is an every man for himself dynamic out there. And so, and that's why I think, that's why I think this paper that we're going to release this weekend might be interesting to your viewers, because we're basically just pointing out that, it's an interesting time. You typically, when you look at the past, and you look at, for instance, the considerations that the powers that be were contemplating when they drafted Bretton Woods, right?
Mm.
The concerns were always that there would be kind of like a beggar thy neighbor approach to competitive devaluation, right? But now I actually think that it actually behooves us to actually have a stronger dollar, from a geostrategic standpoint, even though that isn't necessarily good for the economy. But let's face it, that also aligns with our domestic policy, right? The Fed is actively trying to curtail inflation, and so ceteris paribus, you do want a stronger dollar for that as well.
I just want to underline what you said a moment ago, because that's a really big thought, this complete change in the view of currencies because of the geopolitical backdrop we're in right now. Because it was always, if anyone remembers when Bob Rubin was secretary, he would always say strong dollars in U.S. interest, because everybody thought they were trying to devalue it. And it was the whole, contest with the rest of the world, Japan, to see who could get the trade advantages from a weaker dollar. That was always the thinking, is that there would be a competitive devaluation. That was the concern.
Oh, yeah.
And now you flip that around. It's completely different, that you see people trying to keep their currency strong. That's like a completely different regime that you have to think about. I want to bring up one, in this sort of very cloudy environment with all this uncertainty, another thing that people have been talking about is, trying to figure out what's going on with supply chains, because it's so connected to the inflation situation that we're trying to unravel. My colleague Andreas spoke about this with Jacob Shapiro, who's the director of geopolitical analysis at Cognitive Investments. Let's listen to a clip of what they had to say.
No, I don't think supply chains are going to ease throughout 2023. That doesn't mean that there is an opportunity there, but I think it's a mistake to think that, the last couple of years was, we had a COVID-19 pandemic and we had U.S.-China trade war, and eventually things are going to get back to normal. That's not the way things are going. I think that you're seeing countries, companies, everybody's rebuilding new supply chains, not based on just-in-time principles or efficiency, but based on redundancy and resilience and political risk. And if two or three things on my risk framework pop out, do I have backups, and do I have backup supply chains in place so that I can continue to serve clients overall? So I think in 23, we're still in a world where people haven't been able to do that yet. People are still looking for different countries and different options that they can move their manufacturing to, while still being overly dependent on China or on a small number of countries in the Asia Pacific. So I think this is a multi-year process where you're going to see supply chains reorganize themselves.
That full interview is available on our website. If you're not a member, hit the QR code and find out how to join. Really fascinating conversation. They spent a lot of time talking about semiconductors, which was really interesting. Michael, as you look at, this is like another one of these issues. And as you pointed out, we have them everywhere as you're trying to figure out, is this temporary? Is this a structural change? How is that going to affect? How do you navigate an environment with so little clarity? I mean, is it just having a much higher level of cash?
Well, yeah, for sure. Well, let me just address one point before I even answer that question. So first of all, I agree with the sentiment in that clip, and I was going to mention that the other sort of policy objective of our paper, right, was to point out that we make big comparisons between the semiconductor industry and the oil and gas industry, and we point out that finally, right, the administration, or the powers that be in our government, are recognizing that there needs to be a little bit of a subsidy to incent reshoring of critical supply chains in the semiconductor space. But yet, when you look at the other critical industry, the other critical supply chain, which is oil and gas, right? Because of ESG initiatives, we have actually left ourselves in a very, very precarious position there, right? Between the SPR releases before a geopolitical emergency to all of the sort of hostile rhetoric and threats of windfall profits taxes and whatnot. So we're pointing out that we need to first almost have a Hippocratic oath and at least do no harm. And it seems like we are undermining an area where we have an innate competitive advantage. The U.S. is still the largest oil producer right now. We're producing more barrels per day than Saudi Arabia or Russia, but yet we are undermining an area where we should be really sort of bolstering, But and then to answer your question, yeah, I mean, look, my playbook has been, I don't want to. The theme I wrote about in that macroeconomic pond thread is,
which is great. Everyone should go read it. It's great.
Thank you. It's basically just to show that we had this placid pond. It got interrupted by a big rock thrown in the center, and then even initially, those ripples emanating out from the middle of the pond, representing sort of the ever widening arc of inflation, right? That was relatively easy to call, at least, so for me, I was very, very, bearishly positioned throughout the year. But then as these ripples start encountering some kind of resistance, right, in the form of counter ripples, meaning, Fed action, demand destruction, some of those ripples wind up counteracting, some of those counter ripples wind up counteracting the ripples. But then there's this confusing interplay where some of the counter ripples actually augment the original ripples. So I'll give you an example of that. So when I talk about the dollar, right? The dollar, a strong dollar, is a counter ripple to inflation here. But it is an augmentative ripple outside of the US. And so then what does that do to central bank policies outside of the US? It's so hard to read. And so I just want to highlight that I think at the end of my thread, I basically said, look, I think we're in this environment, which I call the big chop right now. It's basically, you think of a pond where you've got ripples everywhere and you can't even see your own reflection anymore. And the big mistake would be to read every little ripple as like the start of some big new trend, which, the number of times that I've seen with this recent risk on, calling it like, the start of like a brand new bull market, I just kind of roll my eyes. I'm like, what possibly are they seeing that I'm not seeing? Because to me, that's as clear as mud. I cannot see that. And I just don't want to commit any unforced errors here.
I think this is a really important point to bring up. It's something that we touched on in the newsletter as well today, inspired by the fact that you were coming on. And I think we're so programmed for action, right? The idea of sitting and not doing anything feels uncomfortable. People are trying to time it. They're trying to get that entry point, but maybe that's not always the right thing to do.
Yeah, so today I went back and I had this I kept this ongoing investing ruminations thread over the last 2 years, and I really it's kind of like my own journal of like trading lessons that I've learned throughout my career, and I put it in an ongoing thread. But then I thought, you know what? I actually went and I collated it and I put it on my Substack today, and just rereading it actually just helped me think of. I need to take my own advice, is what I'm saying. And one of the and you when you talk about patience, that's a critical one, right? Because yeah, I have twitchy trigger fingers too, right? I've basically been in professional money management for like close to 30 years, and even though I'm officially retired from that, and I don't have to do that anymore, I still have that urge to overtrade sometimes, and I have to sometimes force myself to go in a different room, even away from my screens, and go read a book.
Yeah. Remove yourself from,
That's right.
from the
Yes.
danger. So
Yes.
I'm going to completely, you're all going to support me if I get in trouble. I'm going to go a little bit longer on this one because we haven't had you in so long, Michael, and you brought up so many good things. We have people asking about where do you see the terminal rate for the 10-year? What do you think the range of the terminal rate on the 10-year will end up? That's from TC.
You know what? I don't want to poo-poo the question, but I've said this before in these spaces. To me, that's kind of like analyzing the tread depth of the bulldozer that's about to roll over your head. I don't really care. It's gonna be a painful point, whether it's gonna be 5.25 or 6.25. But I don't really care about that, and I don't trade that type of those types of minutia in a way.
Mm-hmm.
I'm not that kind of a trader. I tend to look for high conviction fundamental. Most of the money that I've made in my career has been on micro trades, even though most people on Twitter know me for talking about macro stuff.
Mm-hmm.
I'm really biding my time to find micro bargains when the shit really hits the fan, and I don't think the shit's hit the fan yet.
Well, and that's saying something. Another question on your view from Chilean X. What's your view on gold in the current environment?
Gold has always been a real conundrum to me because it's very, very noisy, and I think like Bitcoin, the problems I have with a sort of chameleon asset class where the narrative keeps changing. Sometimes it's a hedge against inflation, sometimes it's a hedge against a fight to safety, whatever you want to call it. I don't like those types of trades because I can't clearly identify what the underlying driver is. As my good friend Alex Stahel points out, he's done some interesting regression work on gold. And he says that basically, based on where we are in the macroeconomic cycle, the gold should be closer to around 1100 or 1200, and the fact that it's so far above is obviously indicating that central banks have been the primary reason for the divergence, right? So I guess you could argue that okay, maybe that continues, and that's a positive catalyst for gold. I actually tend to take the other side of the argument. I worry that how do you know when the central banks are done buying, and whether or not the central banks need to liquidate gold? Okay, especially since the central banks that are buying are probably the sanctioned central banks, right? That are trying to get away from the U.S. dollar. But if they're stockpiling gold, at some point they need to pay their bills. Where are they going to sell?
Yeah.
Okay, so
great point.
So that worries me, and so the fact that the distance from 1800 down to 1200 is a very large gulf. That doesn't make me feel good about gold. And the last thing I'll say about this is that gold, I guess it's the closest you can come to a commodity that's also considered to be a form of money. but it's non-interest bearing money. And now you've got interest bearing money paying you 5%.
That's right.
I'll pass. I'm not a fan myself.
Yeah, excellent points, and counter to a lot of what we hear from people who are bullish gold, who tend to be kind of firmly in that camp. We're out of time, but I want to ask you one last question. We dropped in the chats where you can find Michael's Substack. In one of them, you talk about something because we've got so many things that seem like they're on a hairpin. We've got these geopolitical stresses, central bank stresses, currency stresses. We've had people ask in the shows, what do you think the next Black Swan is? Which we know it wouldn't be a Black Swan if you can identify it. But you talk about gray rhinos, which I thought was so interesting. What do you mean by that?
Well,
beware the gray rhino. What's that?
Well, that's actually okay. So in my last weekend, I put out a thread that talked about this West Point symposium that I presented at. And it was basically just summarizing some of the keynote comments from one of our ex-ambassadors. And he was talking. I found that it was the first time I had heard that term. And as I kind of wade into this sort of military realm of things, I find it just fascinating because the lingo is a kind that I'm not used to. But a gray rhino is defined as, I guess, something, a threat that is well known, well broadcast, right? But yet largely ignored. So a relatively high probability threat that is yet largely ignored. So when you when you told me that you're going to ask me about that, I was starting to think, what could that be? I mean, I'll throw one out there. I'm just shooting from the hip right now, but I think a gray rhino would be a geopolitical event that spiked the price of oil, for instance, and we get caught short because our SPR levels are so low. Everybody's been talking about it forever, right? And oil prices are soft because of demand destruction and whatnot. But yet that is one of these gray rhino things that I think people just sort of just poo-poo and just say, it's not there. And certainly I feel like the administration treats it as a gray rhino, and that worries me.
Yeah.
That's how a gray rhino can morph into a black swan.
Right. And they're highly impactful. I think it's such a great, thank you for introducing us to that, because I think that I'm sure that it's in the military, they may have been talking about it, but I think economically right now, given all these sort of, interconnected threats, it's that perfect storm, right? It's like everyone knows it's out there, but no one thinks it's going to happen because they didn't anticipate that these events all happening at the same time. And that's always like sort of the match in the dry hay. So that I think that's so interesting. We're gonna stay on that. Michael, we're out of time. This has been such a fantastic conversation. So happy to have you back on. And we're gonna have to have you back on a Friday when we can do it for an hour and really delve into I think everyone's really excited to hear about this piece that you wrote about the dollar. Everyone stopped talking about it, and we shouldn't have, and it's still very much an issue. So really interesting thinking around that. Hope you'll come back and dive into it a little deeper.
Absolutely. And next time I'll wear shoes that match your blouse.
Yeah. Well, first of all, you have wicked shoes. I saw a picture on Twitter. You have some killer shoes. We know from the Mosh Pit reference that you're a music man. You're going to have to come on My Life in Four Trades so we can really get into some of those interesting parts of your life. You're going to have to do that for me. You come on the podcast. It'll be great.
Good. Awesome.
Michael, so much fun. Thank you so much. Thanks to all of you. Everybody's been loving it and commenting as we go. So there's a lot of appreciation for you today, Michael.
Thank you so much, Maggie. Appreciate it.
Awesome stuff. Thanks to all of you. We'll be back again the same time tomorrow. In the meantime, take care and good luck out there.